Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the inflation data and what it means for mortgage rates. As always, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. It's early Friday morning. I'm in Florida. You're in New York.
I am in New York. We're both on East Coast time, so we can get up early and do this.
Yeah, so this is very early for me. And what a week. It's inflation week. And even with inflation coming in hotter on the core side of things, mortgage rates are still near year-to-date lows. And the spreads. Thankfully, the spreads are doing what they normally do. I think now people are starting to, like yesterday's pricing when the 10-year yield went vertical, 10 basis points, we were flat for most of the day up until toward the end where there was a little bit of repricing higher. But if the spreads had not improved from 2024 levels, even especially from 2023, mortgage rates would be so much more elevated than what they are. But we're at that point of the cycle where even like we talked about last time, even when yields go up, it limits the damage. And I think yesterday was a really good case for people to see about it.
Okay, let's talk about the inflation. Let's talk about the numbers that came in and whether they surprised you or whether you thought they were about right.
So for me, I look at it in this way. The Federal Reserve raised their inflation expectations. So they told the marketplace 3% inflation. And really that's PCE inflation. That's, personal consumption expenditures. If you look at both the inflation reports, you could kind of still see that companies are really taking the brunt of this damage. But with commodities inflation and food inflation, we're tariffing bananas. Why are we tariffing bananas? And because you're not tariffing air, the PPI inflation number was hot, and it's going to be very hard to break under that 418 level on the 10-year yield that we've talked about, unless the labor data gets weaker. And if the labor data was not weak at all, the 10-year yield is 450 to 470. Mortgage rates are close to 7% or higher in this environment. So whether you are pro tariff or not pro tariff, the bond market doesn't care, doesn't have feelings or emotions or anything. The bond market is telling you, boy, you really need labor data weakness to justify getting kind of any lower. So a lot of the pricing is in. So this becomes this battle between labor over inflation and the Fed and the marketplace. And the marketplace is still not, because it's a fair question. If the labor data is weaker than it was last year, why isn't the 10-year yield? Last year we got to 3.63% on the 10-year yield. It got near 6% rates because the bond market believed that the economic data was getting weaker but the Fed's inflation expectations were lower last year. They're higher this year, and they're not forecasting breakaway inflation or anything like that, but they're at 3%. They're 1% above their target. So it becomes more of a, retail sales is about to come out in about half an hour. All these economic data are going to get more valuable. If the growth rate of inflation was heading toward 2%, in that context, it's different, but we're heading toward kind of the target level. So it becomes a little bit more complicated. Knowing Trump, probably he's going to have a game plan against companies that raise prices. I could totally see this happening over the next 6 months. If prices start to go up and people see it, he's probably going to go after companies, and publicly call them out. Because Bassett talked about, well, we believe corporate profits are going to go back to pre-COVID levels. See, that's a legitimate claim. Somebody has to pay the price. Right. And if corporations are going to eat it, then Besson is right. Their corporate profits have to come down to offset it.
Talk about what this means for, we've been thinking that a September rate cut's baked in at this point. What does this do to that?
September rate cut is still in. again, the labor data, there's a lot of discussions. Some of the Fed presidents were talking about, well, you know what, if job growth is slowing down because population growth is slowing down, a lot of people are using that excuse, even for myself. I mean, I would say 78,000 is kind of break even. We actually talked about this a few months ago. If population growth is not there, if the labor force growth is not growing, then you don't need as much. However, that's not this labor data that's getting softer. Continuing claims are at a 3-year high. Manufacturing jobs are being lost. Residential, this is not about, population growth. There are systemic data lines that are starting to get softer. So because of that, mortgage rates are year-to-date lows, basically. The September rate cut is in. Of course, a lot of people say, well, now that with the PPI inflation and CPI, you're not getting a 0.5% cut. But really, the job data needs to warrant it now. Because if we were printing 133,000 per month, there's no cuts. And we talked about that. We made that podcast recently. What is the case for no rate cuts? Well, the economic data has to outperform. Labor data can't be getting weak. And consumption is going to hold up even with some of the pricing getting stronger. So that's the case for no cut. So we're still in the rate cut, but so much of the mortgage pricing is already in, right? That 10-year yield is not breaking that 418 level, anytime. So this isn't, who cares if they cut rates? It's irrelevant to mortgage rates because so much is already priced in. This is what we're trying to see. The market gets ahead of the Fed. The rate cut is irrelevant. It's the economic data that takes you there first, and the Fed follows.
Which is why last year in September, we had a rate cut and mortgage rates went up.
Well, last year was such a different case because last year the 10-year yield was at 363. That was we were so ahead of the Federal Reserve that if we weren't breaking down into a recession, bond yields have to go straight back up. That the Fed was so behind what the market was. So it's the rate cut is irrelevant in that discussion. Now, rate cuts happening allows the band to go lower. This is a good example of this year. Why we have year-to-date lows in mortgage rates. But if the labor data starts to improve and the economic data starts to improve, we're not going much lower than where we are right now. That's just how the function of markets work, and what happened with the inflation data recently.
So you and I talk about this all the time, literally every day. You're writing about it. We're talking about it on the podcast. And I still if I'm out there and I'm running a mortgage company, if I'm a real estate agent trying to figure out what my fall looks like, is it hey, just about what it looks like now? That's where you're going to be on mortgage rates.
If the economic data gets weaker, you can go lower, but it needs weaker economic data. This is why we want to teach people you have to follow the labor data. You cannot sit and wait and say, well, so-and-so said 3 rate cuts, so-and-so for 4. That helps in the future. The spreads are really good. But what Inflation Week showed is that, there's levels that you're going to need to earn it, because this is not like we're heading toward 2% to the target level. The Fed raised their inflation expectations. If we were heading toward 2% and inflation targets were 2%, that's a whole different story. 10-year yield is, fighting the Hodor line, but that's not happening. And for right now, it looks like the brunt of the damage is taken in by corporations. But this is something to be mindful of, because what the 10-year yield did this week is not abnormal to me. It's basically saying, hey, listen, this is not heading toward 2% anymore. The PPI inflation hot, core CPI is 3.1%. You really need weaker data to warrant heading any lower at this point. And of course, we're year-to-date lows because the spreads are better, which is the blessing, because if that wasn't the case, you're much higher this year with mortgage rates.
Once again, the spreads are the hero this year, keeping mortgage rates low. So one of the things that I've heard about the labor data is that, and you talked about this, if you're just not growing, population growth, and if you're taking immigration out of the equation to a large part, what does that do to the labor data as far as how many people are working? You talked about this before, your employment rate can change because what's the denominator there?
So the unemployment rate can stay lower for longer if your labor force growth isn't growing. the last few years when the unemployment rate was rising, but we weren't losing any jobs, is because the labor force growth was picking up. So you have more people looking for work. Because you have more people looking for work, the unemployment. Now, there's this huge fight going that there's nothing wrong with the labor market because population growth. The Federal Reserve is starting to go to that tactic. Also, some other people are starting to go this. That's not what's going on with the labor data right now, because you wouldn't have manufacturing jobs being lost. You wouldn't have residential construction jobs being lost if it was just population growth. Those are two key sectors. Of course, there is the AI impact, data centers being built, whatever the money is going to AI. We do see labor weakness that has nothing to do with population growth out there. So there's a difference, because a lot of people are saying there's nothing wrong with the jobs report because almost everyone is working. Continuing claims, manufacturing data, and residential don't show that. That gets into a little bit more of the sophisticated discussion of labor force. But this is one of the things we talked about before the year. If the labor force growth stays constant and grows, the unemployment rate is going to rise. If it doesn't, unemployment rate can stay lower for a longer period, even if job growth is slowing down. We're running a 3-month average of 35K. No, even if you adjust it to the most extreme labor force growth, that is a very, very negative trend, and that has nothing to do with population growth out there. The Fed is starting to make that debate, but that's not what's happening to the labor data right now. Continuing claims are elevated at a 3-month high. Manufacturing jobs are being lost. Residential. These are things that toward an end of a cycle, it becomes very apparent. So we don't want to ignore history here. The labor data isn't breaking because jobless claims isn't breaking, but it's definitely softer. And it's not all population growth slowing down.
Okay, so we had some, I think Trump said that he might do it sooner rather than later as far as name the next Fed chair. What did you make of that?
It's all a game. We talked about this last time. They have like 11 people now out there, and then he's talking about choosing. I think settling down on a Fed choice. Partly I think Trump likes having Powell as a punching bag. But partly is, when you get all the deals in and everything, then you can work on something. But we punted China away for another 90 days. And there's just a lot of friction going on with that. I don't know if he's tactically waiting for a certain moment to do this. But man, does the economic data become more valuable now out there? Because I thought what the bond market did was correct. It doesn't matter who the Fed chairman is at this point. You can't have core CPI at 3.1% and PPI inflation rising, and then think, well, we're heading back to 2% at that point. That's not happening anymore.
Okay, so what you're going to be looking at retail sales today, but that doesn't usually move what we look at too much, right?
Consumption is one of the more hawkish Fed presidents said consumption data is holding up. So retail sales does matter because the Federal Reserve likes to use the real sales data and GDP as their barometer of the economy. If you lose that, that was one of the weaker things in the GDP report. Consumption is slowing down. So the Fed believes that the reason they're not hiking rates is that you don't hike rates into a tariff situation because it just makes things worse. But as Jerome Powell said, we're kind of ignoring the inflation data now by not raising rates. Well, the Fed funds rate is still elevated to the growth rate of inflation, even if you take the CPI report. So they still feel comfortable with that. But it just becomes the economic data just becomes more valuable. If CPI inflation was down to 2.25 or whatever, and PPI inflation was light, whole different story. We're talking about this week. We possibly could have broken that 418 level. That's just not the case. So in about 30 minutes, we're probably going to get retail sales, and the 10-year yield is at 429. So we get to test now this battle, because if the labor data wasn't weakening, they're not cutting in this. They're just going to say that, and the bond market kind of agrees with them in that context.
Okay, we're recording this on Friday. Of course, we know lots of things can happen over the weekend, even today. But assuming someone's listening to this on Monday morning, what are you looking at this week?
Well, basically, we want to see how the bond market reacts to retail sales, anything over the weekend. Where we are right now is basically as priced in a quarter. right? So it doesn't look abnormal to me at all. But if we're going to get into this inflation versus labor over inflation debate, the labor data better stay softer, because if it doesn't, then the Federal Reserve is going, hey, listen, it's not breaking. So it gets into an interesting, whoever the next Fed chairman is going to be is going to have to kind of say, hey, listen, we're going to get hit on the job side, and tariffs are a one time price adjustment. Everything will eventually work itself. It's going to get difficult, especially with commodity inflation, food, stuff like that, for them to totally ignore that. So the quarter is kind of priced in, but it just becomes, the jobs data just becomes more. The jobless claims came out. It shows a softening labor market with continuing claims elevated, but the initial claims is still historically low.
Okay, well, I know you're on it 24/7. Appreciate that. And thanks for doing this. We'll do it again tomorrow.
Pleasure.